Little device. Thank you. Yeah, this is the November 17, 2022 meeting of the Retirement Pensions Subcommittee. And so I guess the first order of business would be simply to welcome James.
Oh,
thank you so much.
Thank you.
We appreciate your willingness and commitment to come and join our happy little band. You know, I would say that we're all relatively new to this committee. Colin, you're probably less than a year. Is that about right?
I think that's right. I think I joined last year, early last year.
I think Diane,
Yep.
maybe two-ish
You?
for me.
So you're the senior member.
Right. It's just one of those things where, you know, any volunteers and everybody else stepped back, and there I was. Yeah, and Neil Budnick, who recently retired, was the chairman for, well, as long as anyone can remember, is probably a fair description. And so we might miss a half a step because Neil's not here, but Diane will make sure that we don't wander too far afield. And so Judy, are you joining our happy band as well? So yeah, so Judy, well, welcome to our committee. You may have been a member of this committee or subcommittee way back, but like all good things, you've returned.
Just taking notes.
Yeah. So
Hey, Tom, I think Michael Chen used to be on the committee too. Is he?
Michael used to be, and he has recently asked that he not be on this committee. He's finding it hard to make the meetings, and of course, anyone that bears the burden of the BOE, you know, we give them a free pass because that is that's an awful burden. So be that as it may, I suppose our first order of business would be to approve the minutes. So obviously James should get a pass. I've taken a look at them, but so Colin, you good with the?
Yes, I am. I looked at them earlier and I'm fine.
So then all in favor, I think we're good.
Okay.
So the minutes have been approved. Does everybody have Diane's email with the attachments?
Yes.
So that sounds good. And let me just ask, only because the systems and the platforms on our tablet have changed enough
I know.
that whereas my confidence level was never terrific before, I'm now to the point where I'm asking more and more questions. But is there a way to put these on, what was it called, OneDrive or whatever? We're doing?
Yes.
Because that way then I won't have to search for old emails, right?
Right. Well, I thought they were going to be on that one drive, and I think Pam and I.
So if we can just endeavor to do that going forward, and if there's a tech issue that you need us to help with or whatever, that'd be fine. But yeah, so the new OneDrive system and of course the new email system has all made it a little funny, but yeah, so going forward, we will have, you know, a platform with pages that we can navigate. We'll be able to go back and forth with these things. So what we're going to do today, typically, and you will have seen the draft agenda, so thank you so much for that, is, you know, we're to speak with Vanguard on our investment performance. So there's two principal advisors that this committee speaks to and interacts with. One is Hooker and Holcomb,
Right, the plan actuary.
yeah, so they do our actuaries and they help us do the what does this mean for us, right? And then Vanguard watches the investment sides, right? And then we're kind of like, where do we sit in the rest of the world, right? You know, how does that all work? And you know, we have actually undertaken from time to time, you know, we've paused and said, are these the right folks for us, right? You know, every once in a while, you got to say, well, you know, should I switch it up or whatnot? I would say we've been very pleased, my own personal opinion, we've been very pleased with the service we've gotten from them. I would say, you know, Vanguard is quite good and they're, I think on a relative matter, not all that expensive.
For the cost.
For the
correct.
cost that we get and, you know, where our plans are, you know, we're overfunded, you know, all that fully funded. So, you know, we're in a different place than a lot of these types of pensions, and so our kind of profile, you know, our guiding north stars are a little bit different than if we were underfunded and we're trying to make up some ground and all that kind of stuff. But anyway, so today is Brian Binkley. Is that right?
You're right.
So
yes.
Brian is come, and if Metro North were working, he'd be here now. And he's going to take us through these pages. You will flip through that, seeing the red ink. We are where we are. And so we're going to get some guidance from him. So a couple of things that I have on my notes, and I don't know, again, it'd be helpful if Neil were here, but Diane, maybe you can help me understand this, which is what we had agreed with Hooker and Holcomb, that what we would do is we would engage in a valuation somewhat more frequently than perhaps we otherwise had to. We would elect to do the evaluations because many other similarly situated funds found it advantageous to do that so that you could smooth the performance and how that actually affected our reporting, right? So, so the fiduciary concept of how it affect our reporting, and that could have some impact on not necessarily the level of the contribution directly, but also because we would capture perhaps some upside value, you know, but we're smoothing, right? We could use some of those funds to pay current expenses. We are a fully funded plan. We have this money, it's sloshing around. Why would we use the general fund from the town, right? And so we would try to get, you tell me if I'm getting this wrong, because there's a reason why Colin and I went to law school, which is we're not that good with the numbers. But so the idea was we agreed, and you know, and we tested it and probed, you know, other towns do this. Well, not all public pension funds do it, but certainly it's not unheard of, and people do it in the private area where private pension funds, they do it much more frequently. There's nothing that would make us, you know, a complete outlier. It's totally fine. And so we have to complete the smoothing conversation, I think. I don't know how complicated it was, but I think there was yet to be decided a few things about how it would work going forward, or maybe I have that wrong.
I thought the committee approved the concept of smoothing.
We certainly did. I think there was perhaps some optionality about the specific manner in which some of it might be done, but we didn't need to make that decision right away.
I think,
My notes kind of said it. Remember, I was kind of agitating for a meeting before Labor Day.
right,
And then it was decided, oh, no, we answered 90% of it. I thought we only had answered 50%. And so everyone said, we don't need a meeting, and I was okay. And then Neil stepped down. So now it's like, okay.
right. Well, you summed it up very well. The smoothing is advantageous because you don't have these big whips of gains and losses year after year that you're having to report on. So it's helping to mitigate some of that, those swings. The reason why we want to also do these valuations frequently going to give us a better idea of what the town needs to put into the plans.
Right.
Even though the pension is overfunded, there's still contributions that need to be made that the actuary determines through evaluation.
Right.
So they are currently working on that. And hopefully they can be back in here in February, which is part of why I threw out this meeting schedule that I'd like the committee to approve. And the reason for having a meeting schedule laid out ahead of time is that so the meetings are recorded with the town clerk, and it's a regular meeting as opposed to being a special meeting where we really can't add to the agenda.
Right.
But we could have Hooker and Holcomb come in likely in February. It's taking a little bit longer this year to prepare the valuations, both for the pension and the OPEB trust. But they would come in and then say, here's what the town's actuarially determined employer contribution is.
Right.
And that those numbers would go in the budget for fiscal 24.
Correct.
So that's that arm, whereas Brian Binkley, who's coming tonight, is looking at the investment side. What's the market value? Where are we vis-a-vis our peer group? And then the big question is the discount rate that the actuaries use for valuing the liabilities. That is always a big discussion that this committee looks at in more depth before the whole board looks at and makes a decision. Are we looking at the right required rate of return?
Right.
Which,
And Hooker and Holcomb have been very helpful with us. You might remember, Colin and Judy, that they provide us with a lot of summary data. I would say most helpful from my perspective, James, and you may have more that you can add to that analysis is, but they take us to our peer group towns and what are they doing? And then they give us a lot of information about, well, what is the funded status of their plans, right? Is it really apples to apples? And do we really care? Is Ridgefield so different that it's not a useful comparable, that kind of thing. And so we take a look at it and we kind of over the years said, is it a little rich? Maybe not, maybe, but we're still okay and whatnot. But every year we've been inching closer to maybe it is time to ratchet this down a little bit, but we do need to have a conversation. We're making that decision, obviously, of what's in the best interest of these funds, et cetera, the trust. But in addition, we're making this, real-time scenario, which is there's ramifications outside into the budget, and that is a factor that goes into and it ripples through to the contribution level.
correct.
And so that we get a lot of data about how much would shaving 12.5 bips off be, and if it was a full quarter, how much would it be? And so we kind of take a look at that, and we take kind of a real world commercial view as to, what do we think? Again, all in the context of fully funded,
Right.
et cetera, and so forth. And so, we take a look at that.
Right.
So, but in any event, I don't know how long, just because we don't happen to have either advisor here, so it's kind of
Right.
opportune for us to discuss. How long are the current engagements with them? Do they run on like a 3 or 4 year
That's a
term,
good question. I think best practices are every 5 years to reevaluate.
Got it.
Now, even though we've had Vanguard as the institution for quite a number of years, when we change partners within the firm,
Yeah.
it's a whole new set of eyes. Like, I don't know if you were here before Brian, who I think's been on the account
No,
just about 3.
I've only ever
We
seen
had-
Ryan in Vanguard and Hooker, so I don't know if
Okay,
there's a-
so Judy would know this. We had Lucy Momjian before that. We had Wendy Simonson before that. So it's sort of the same when you're switching a complete
Yeah.
team. It's
That
like
makes sense.
switching,
I get it.
because they do put their own spin on what the investment portfolio should be like.
Well,
but-
that I might suggest, subject to anything that Colin and James or Judy might say, is that we should, once we get through budget season,
Mhm,
March, April,
sure,
we should revisit, where are we with those? We want to consider doing an RFP,
mhm,
right? Figure out, does this make sense? We may discover that, the engagement of Vanguard has another 18 months, and then, okay, then we can do the RFP later when it expires, Booker may be coming up soon, I don't really know, but it would be helpful to kind of get that.
mhm,
The other thing I would say is, we'll deal with the specific dates in a moment, but it probably would be sensible if in advance of the meetings in February,
mhm.
with Hooker, if we could get those documents well in advance.
Sure.
I do find sometimes that these things are coming out, 2-3 days ahead of the meeting.
I know.
I'm a little scrambling around trying to find the free time to review those to come in here, but if I could get them a week or more in advance, then we could all read them on a kind of a considered pace. And if there is more to it to consider, we could shoot them some answers so that they could come prepared with our first level answers. What I mean?
Sure.
As opposed to
absolutely.
that, let me go look at it, and then we're kind of flat footed for that meeting. That kind of makes some sense to me.
No, it's-
because my recollection is there was more to do. I'd be, thrilled to learn that there isn't, but I just thought maybe there was something else to consider, like there were different methods by which we could do it, and we hadn't really.
For the
But
valuation, yes.
I could be wrong.
Right, well, then the other.
Tom, can I just add, I agree with you 100% that seeing the analysis of different towns, how funded or underfunded are their plans, what are their assumptions? I thought that was very, very helpful to have. And I was thinking we would get that tonight, actually, but I guess that's not the case. For later on.
Later on, because this is just more on how did the investments, what were the returns and how much ready is there? And then we would have the necessary conversations around. Remember, we've set some policy, James, you will have seen it revealed in some of the, particularly on page 11, but there were we have some investment policies in terms of how we allocate assets. And so we only want to be in equities here and, international here, et cetera, and so forth. And when the swings in the market push us out of that balance, if we get, and you will have seen this certainly in your roles, we have to kind of reallocate and get ourselves back into the policy. And I have to say, we sweated over the decision on what to do, particularly when the pandemic hit and lockdown was there, and markets were swimming. And but we have found, I think, there's not a whole lot of collective experience with people that are here, but I think over the years we have found the benefit and beauty of a policy is it's policy, and it's there, in good times and bad. And I think it's fair to say that it has served us well for now. We'll see some mention in Brian's presentation of some private investment alternatives and what their returns are and what the risks are relative to what we're currently invested in. And that's because some of the smarter former members of this committee, work in the finance field, they kind of said, well, are there other assets that similarly situated trusts might consider that might be a better hedge against volatility, a better hedge against, the ups and downs and all. And so we had considered certain private investments. I think it's fair to say, Colin, that we were still in the, what I'll describe as the kicking it around the room stage.
Yeah, I agree, Tom. I think Mike in particular wanted us to consider it, and we were in the early stages, of consideration.
So I think it's fair to say that we approached it with some measure of reticence because we were, nobody wants to just, let's just put it all on 39 black, right? So we kind of said, well, it's a healthy discussion when we're seeing how's everything else doing, what are private REITs doing, what are, other private equity type investments doing, and is there a particular investment vehicle that maybe isn't too far down that spectrum, but could really serve a good role? And would there be room in our portfolio for that in some measure or fashion? As I said, we never quite gotten there, but Brian is feeding that information so that, discussion and dialogue can continue. I think, kind of stay tuned.
Right.
So there's that. But certainly for purposes of trying to set the assumed rate of return and the related discount rate, the peer rankings among our other towns have proven to be a very helpful tool, because we kind of see what our kind of peer pension and retirement committees are faced with in those towns, given the factors that face those particular circumstances. And I think we've taken some comfort that we really are not out of the thick part of the bell curve. We're kind of sitting there and it's okay. And if this was a multiple choice test, I think we'd be fine. If there was an essay test, different people might have different opinions on the margin, but generally speaking, I think it'd be fine. So.
And Brian's presentation, when he was here last in May 10th, had a great chart, and I can certainly share it again with the committee, that showed where every town in our peer group was on this graph, but not just looking at what their required rate of return was, but relative to their funded status. So
and their size.
Correct, and their size of the town.
Yes.
So we can resurrect that. I was hoping that it might be in here again, but I think maybe that since he thought it was just discussed in May, and the data really hasn't changed. It was based on fiscal year 21
Yeah.
results, because towns don't change their
Yeah.
rates every year
No,
frequently. Some,
right.
there are a couple that do, but for the most part, it's somewhat static. We don't have any information on fiscal year 2020, 2022 for the other towns, nor are we finished with our audit either, so that data is still valid.
They
and I
mentioned
can share
that at the Board of Ed meeting. When are we expecting that now?
When are we expecting what?
The final, the audit to be completed.
I don't
We don't
know.
know yet.
I don't know. It's taking a while. And it's more related to, I would just say, staff on both the auditor's side and our team. In the finance departments had a lot of turnover.
And when was Brian scheduled to come and speak with it? Was it, we were aiming for November, we're now in for December or not?
No, Brian's coming.
Brian's coming tonight, but including from Vanguard.
Okay, well, yeah.
He can come whenever. We would have Ellen Kusinski,
Yeah.
who is the partner at Hooker and Holcomb. Same thing. We, before her, it was Tim Ryer. So even though we've had Hooker and Holcomb a while, and they've kept their rates pretty flat too.
Yeah.
So, they, to your point about going out for an RFP next spring,
Yeah,
they had,
We've had Vanguard now for what, 16 years?
oh, I don't know if it's.
Yeah, I brought them in, yeah.
well, again, the idea was,
The
well,
overall.
I think we were gonna ask Diane to kind of report to us back after this budget season. So in the spring, when we get through the February meetings. And then we can figure out how much runs on their current engagement, and then we can figure out whether or not we want to do another RFP or whatnot.
Right, okay. Well, since we have a little bit of time when we're talking about the calendar and who's coming in when,
Yeah,
I
let's-
did send around a tentative sort of draft
Meeting
meeting schedule, and I believe I prefaced this by saying there will not be, 7 meetings of this committee.
yeah,
The committee is required to meet at least twice a year, but certainly as things develop, for example, you mentioned, Tom, in March of 2020,
yeah,
everybody was on Zoom every
Right,
week talking about the portfolio that was tanking and rebalancing, so. But
Right.
what I thought is to throw out some dates, January, February, and these tie in with the Board of Finance dates. To, I don't know when Hooker and Holcomb will be done with the valuation.
yeah,
Maybe I should throw the March date in here. And then again, just like this spring, we had the RPAC met in both April and May. And this summer kind of was taken.
right.
off.
We thought we might try to do that, and then everybody kind of thought, oh, no big deal, let's
Yeah,
just throw it into
things-
October, and October became tonight.
Right, so.
Well, I have to
if
say.
you have suggestions, I mean,
Yeah, so a couple things about that. I mean, one thing that might be helpful to read alongside the proposed dates, understanding we don't have to approve all of these. We just need a handful, and of course, we always have the ability to.
you can add,
have
like
special
tonight,
meetings.
this is.
Yeah, But what I would say is, do you have something that the 4 of us could look at as sort of the annual rhythm of milestones for this committee, right? In other words, I don't know if I could guess exactly the date by which we need Booker's valuation. I don't know that I could tell you when that is. You see what I mean? So I look at these meeting dates, if I match it up with the milestone dates we have to make. And I could say, well, yeah, I gotta meet there because that's 3 weeks ahead of this date, and that gives us enough time to react to some last minute thing, right?
Right, I'm not sure if I have the Board of Finance schedule
Yeah,
with me. I mean, it's tied to really the budget and then the town
Yeah.
vote, and when, well, the Board of Selectmen have to approve the budget.
yeah.
And the Board of Finance,
You
so
might
we have to back
remember
up
or
to
not
those
change,
dates.
but what happens is the Board of Finance we thrash about with the budget. And then we throw it to the town. And there's some limits and drama and all sorts of stuff about what they can do, and then they bring it back to us in some form, and then we approve it. And there's always a little bit of, you know, how much do we want to buy down the mill rate, because we have a very large general fund, and the general fund is taxpayers' money, so we can use existing taxpayer money to pay down to relieve the burden of existing taxpayers, you know, and that kind of thing. So we're always trying to figure out how to do that. We're managing it, and we're looking at the next year, and we're looking, you know, how much did the ISF grow for the POE and all this kind of nonsense. So within that little mini drama, we do need to fill in what is the contribution number that the actuaries require us to put in, and how much of the accumulated investment balance do we want to use to meet current expenses, which that feeds in as a factor into the calculation of how much the contribution is, right? So that would all need to be baked into the budget that we send to town council. Correct me if I'm wrong, Colin, Jr., that needs to be baked by the mid to late February time that we send it off to town council. Because that's a number that is derived from these conversations, and there's a bit of nuance to it. I don't know, town council, and I mean, they can ask questions and you'd answer it, but that's not a number that's ever debated, right? That just kind of sits in there and it comes back exactly as we sent it, and so that's the number. So it would seem to me that if in order for us to do that, we would need to have the valuation by late January, or do I have that wrong?
Well, that's what I'm hoping.
Well, and so, and their valuation is, do we think that's being delayed? Or
I
is
think
there a reason why we wouldn't expect to be able to get that shortly after the holidays?
Well, I haven't been directly involved with managing that process anymore,
I know.
so I'm just relaying information that you know, a lot of the pension work was outsourced.
Understood.
So Hooker and Holcomb, I think, where we thought maybe they had some of this data now, maybe
Yeah.
they're trying to track it down. So I will get a better answer.
Yeah, I mean, I would say any one of the four of us, I'll volunteer myself, and we'll speak for themselves, it'll be happy to get on a phone call and
Oh, hi, Brian, come on
I
in.
don't want to say lean on, hi, Brian.
That's what.
But we'd be happy to, you know, and if they're having issues getting information
Yeah.
from the
Well,
town in order to do their work,
I think there might
we
be.
can lean on those individuals.
Sorry.
Yeah, I don't, those kinds of issues run in both directions.
Okay. So,
So,
but anyway.
But do let us know, because I
Right.
think it would be important for us to get those reports in mid-January, so that
Sure.
if we got back to them with any sort of collective comments or questions before, you know, let's just use the proposed February 9 date.
Yes,
If we could get them something, you know, some questions by, you know, early February, you know, a week ahead of that,
right,
then they could come here armed with answers to our first level questions. And we would feel like, what, either some measure of comfort and satisfaction that we got what we wanted, or at least that we're a week ahead of where the process otherwise is, if, you know, we really kind of stumble into a conundrum, right?
right.
So I think that would make some sense from my perspective. I don't really see a need to meet in January,
Okay,
personally, if we can get the report in mid-January.
sure.
I'm happy to keep the second one in February, because I think that will help us modify and
The February 28th.
yeah,
date.
20th,
Okay,
and bring some closure to whatever it is that we see, right?
sure,
And I think you said at least these dates in February line up exactly with Board of
Sure.
Finance anyway.
yes, there's the
Yeah.
Board of I just pulled up the Board of Finance calendar. It's
Yeah.
February 7th, 9th, 14th, 16th, and 28th.
Yeah, so I'd be good with
They're
this.
all, it says regular /
Yeah,
budget.
I'm with you.
Okay, all right, so we'll
And-
keep
and,
those,
um,
and then,
And then I think,
And-
yeah, we went May, June, and then October, November.
does that sound good?
Yeah,
right.
given the fact that we can always modify it as we go, I don't see a pressing need for the January meeting.
Perfect, I'll take that off and then, want to make a motion to approve this meeting schedule, subject to the.
Yeah, so
removal
can
of-
I have a motion to approve the schedule as proposed with the removal of the January date?
I,
Okay. Second. So moved. We got ourselves a schedule for 2023. Look at that. So, and without further ado, and with some measure of, I feel your pain. Being an excellent yeah, so welcome, and we'll have to speak to our elected representatives about the public transportation service. So, thank you. So you met James.
Yeah.
And, so Neil has retired, and right, so I believe we're always going to keep an empty chair for Neil. And yeah, and so Michael has moved on to other assignments within, so so this is now the starting lineup. And
right.
but in any event, so we have quite the report with
Right.
And we've been waiting, reading any of the headlines or watching CNBC.
Right.
We kind of knew where the plot was headed
Right.
directionally, but
Yeah.
it's always helpful to get the color in the story. So if you want to kind of walk us through, you know, being that it's 6:33,
Right,
so
and I
you can
think
skip.
the
what you
end
have to do.
Yeah, right.
Yeah.
So that the
Yeah.
group can get to the.
No, of
next-
course.
Okay.
You know, I could speak to a lot, and because to your point, that you all know that the headlines, and then, you know, I'm gonna jump different parts, but if I just summarize or started with the plan performance,
Yeah,
you know, and that's straight on page 11.
yeah,
You know, we have pension, OPEB, you know, the Marston Trust.
right,
So all down a lot, right? So yeah, the pension plan down 19.08, talking about the year-to-date basis.
yeah,
I won't flip to the OPEB, but it's the same allocation, it's down 19.06. And then Mildred Marcy Trust, slightly different allocation, it's down 18.9%.
yeah,
So that's reflective, certainly the downdraft in equities, which while bear market and over 20% at one point, it's certainly not the worst start for equities. The bigger story has been just the weaker start for fixed income.
Yeah.
And so if I just try to put this in perspective on page 8,
Yeah.
you never it's the worst start to the broad fixed income market index since it started in 1976. But if you just got rid of the Barclays Ag, you know, that's the index that started in 76.
Yeah.
You have to go back to the Civil War or before. So it's never been a worse market
Yeah.
for fixed income. And on page 8, so you could see that red line of where we are, but also we just have a grid to the right of it of, you know, what have been the returns since 1976 for fixed income. You know, we've never even had a fixed income market down 5 to 10%.
right,
So that's where we are. So that's the old saying of there's no place to hide once you're in cash, right?
right,
But it's very hard to time markets going in and out of cash. So we never advocate for that.
of course,
What we would say, you know, looking forward, this is not to predict the markets, but you know, the diversification benefits of fixed income, we still believe will hold. It's just been, the Fed has also been in an unprecedented tightening mode. It's the most aggressive the Fed has been, again, maybe even more aggressive than Volcker. Maybe not by how high rates have gone,
yeah,
but how fast they've gone down, right? We went from 0 to 3.75%, which is the Fed funds rate right now. I was on page 8, but I'm just kind of speaking to the different
yeah,
parts.
but I agree with you, the 75 and the 75 and the 75 is just blinding.
Correct. So therefore, that explains the weakness in the fixed income markets, but the diversification benefits for fixed income should hold, especially as we roll into 2023. And, you know, our base case, and I don't think we're alone, is recession would be in front of us in 2023. So the markets are always forward looking. At some
Yeah.
point down the road, I don't know if it's a year or so away, then you'll talk about cuts to rates and
Yeah.
that'll benefit fixed income. So I'm giving this all backdrop of saying that the portfolio is still well diversified and that diversification benefit should stand. 2022 has certainly been an anomaly because of high inflation and therefore high interest rates.
Right.
That's the nutshell of where we are from the asset allocation perspective. The silver lining, in which it always comes back to the pension plan in the town, is if you went to page 24. And excuse me for jumping around just to do it in brevity, but I want to leave time for questions too. So on page 24, we always look at what's the expected return for this portfolio as we look out 30 years. And we do 30 years because that's what the actuary uses to set their assumptions and how much you have to contribute or into the plan. So the discount rate for the pension plan is, and the OPEB is still 6.75 is my understanding.
Yes.
So now looking at this portfolio, is the expected return at the median is 6.6%. So very close to that target, and 6.75 is within that band of the 25th to 75th percentile that you see in the middle of that page. So that bodes well with respect to your discount rate and how that may have to shift or not shift, and then contributions to the plan. That's dramatically different from where we were a year ago. So on 12/31 of last year, because of how expensive equities are and because how low rates were just 10 months ago, the expected return from the portfolio was only 5.6%.
Yeah.
And so public plans, New Canaan has done it gradually, but generally speaking, we're bringing down the discount rate because expected returns have compressed so much because of that market. So valuations in the equity market are more attractive. We think they're just slightly above fair value. We don't think that they're cheap.
Right.
The valuations have shrunk, but you really haven't seen big downgrades to earnings estimates, and that could continue to come in 2023, again, if and when we go to recession. So could be more downside for equities in a recessionary environment. But it's also maybe capped where the long end of the bond rates would go.
So resetting these market indexes and relative valuations there are removing some of the pressure we might have otherwise felt.
Yes.
That our discount rate was starting to fall into the somewhat harder to justify.
Correct.
So now it's kind of back towards, well, it's in the range.
It's in the range. You could still think about the actuary 25 basis points and maybe cut to it to be really conservative.
Yeah.
Because that always, again, has implication in the contributions. But yeah, so more fairly valued with respect to your discount rate. The markets are more fairly valued, but certainly not cheap, whether it's equities or credit valuation.
Yeah, understood.
So I think those are the big things.
And then what about, maybe you're going to get to this, so if you are, then just continue on the plan, but I think we would like to at least have your input for a little bit of a dialogue about the need to rebalance.
Right. So the need to rebalance, for the benefit of Colin and James, is we set the rebalancing thresholds at the asset class level of plus or minus 5%. So once equities get plus or minus 5% from the target, and the target is 65%, fixed income target is 35%, then we would rebalance. Right. We certainly hit that in the past during the periods of COVID and other periods, but because this year, as I mentioned, everything really came down together, we didn't hit any rebalancing thresholds. We came very close on the OPEB. So on page 13 is the OPEB plan. You could see like a 10th of the way. The equity allocation is 4.9% away from the target as of the end of October, but it never got to 5%. When I even looked at as of last night's close, it's come down since then. The equity, excuse me, we didn't come close on the pension side because the pension has regular contributions and disbursements, and we use those cash flows to rebalance.
Right.
The OPEB doesn't really have much cash flow. This year it's only been $35,000. But on the pension, we've had 1.7 million in contributions. We had 6.4 million go out.
I see. So you can use that to kind of make finer adjustments.
We use that to rebalance the target instead of having the buy or sell.
Okay.
Now, rebalancing is always, worked well for doing that, in the pension plan and when the markets get out of whack. And we set that 5% threshold because once you get beyond 5%, you start to change the risk profile of the portfolio. Now you're more like a 70-30.
Right.
That's a different allocation. And we don't usually set it tighter because it'll just lead to more turnover. So we found 5% is a good balance as far as keeping the risk profile, because rebalancing is all about risk.
Yeah.
You set the committee, the town has set an asset allocation, a risk tolerance, and we want to stay fairly close to that.
Right. Okay.
We've had previous discussions about adding different asset classes. So, Colin and James, you only see 3 funds in there, but it's, at first blush, it's not that diversified, but the total stock market index, which represents the US equity allocations, large, mid, small cap stocks, it's over 4,000 securities. Same thing with the total international stock market index that we have in the portfolio. That's developed and emerging markets. And that's over 7,000 securities. So we're capturing the broad equity markets, US and overseas. The other asset classes that we've talked about in the past is private equity comes to mind. Private equity, the downside is you're really talking about a 12 to 14 year commitment.
Yeah.
Really illiquid. But you also want to think of it in context of, do we need the additional return? So coming back to the discount rate, typically there's been a premium or private equity, if you're in the top managers, have given you a return over the broader public markets, but you have to sacrifice that liquidity, higher fees, etc. But given the strong funded status of the plan,
Right.
and that this portfolio is close to the discount rate, we haven't felt the need to go into an asset class like that.
Yeah.
The one that is maybe more tenable is private real estate.
Right.
And now we do hold REITs within the total stock market index, but that's different. We don't have a dedicated allocation to private real estate. We really think of private real estate where we would fund that is from fixed income, because at least half of the return over private real estate over long periods of time comes from the income the properties generate.
Right.
That is illiquid to a certain extent. There's usually quarterly liquidity for private real estate. So it's certainly an allocation that we've talked about before. We haven't moved forward. We can revisit that one.
Yeah.
As far as the diversification benefits it provides.
Would you have, if it was in here, I'll apologize.
No.
I haven't a chance, but
Yes, it's a big
would
bet.
you have a sense of, relatively speaking, how private real estate might have performed or not performed relative to, our typical menu?
So this year so far, and even the private real estate works on a lag. So they just coming out with returns as of 9/30. But private real estate has been positive this year, maybe like by 1% or something like that.
Okay.
So
like
flat is slightly up for private real estate.
which is a relative matter, is impressive.
So that's where the diversification benefit is,
Right.
as far as it's not as volatile as the other public market asset classes. Now, it works with a lag. So, these higher interest rates will catch up with private real estate. I've heard directly from some private real estate managers that they're creating redemption queues because plans want to sell, but they don't want to sell into this market. So private real estate will probably continue to come under pressure just with the lag.
Yeah, and isn't it the case, I mean, certainly not my area of expertise, but some of these private REITs are mortgage REITs, right? They're not owning properties, they're holding mortgage loans,
There are mortgage REITs out there.
which will be somewhat more interest rate sensitive.
Right, that's right. But if you look at the public REIT asset class, that's down like 29% year to date. So it's down more than the general equity market because of how interest rate sensitive it is. So REITs, which are publicly traded, are much more volatile.
Yeah, okay.
So how would the private real estate, how is that invested in you have an index, you have pools of.
Yeah, it would be a separate agreement between the town and the real estate manager. We've looked out at the private real estate market, and partners the right word, but there's a firm that we work with our clients. The name of the firm is IDR, Investors Diversified Realty, and they've really looked to replicate the private markets and buy each of the underlying managers. So if you look at the private real estate market, there's about 26 different managers that make up that index. UBS, JP Morgan, BlackRock, all the big fund players and smaller ones. And so they go out and actually buy exposure to all of those managers to try to replicate the index. And they've been able to do that pretty well with very low tracking error to the index, instead of trying to say which private real estate manager is going to outperform. So yes, it would be a pooled fund with other investors. That fund is around over 4 billion. A lot of public plans, including like state plans, have invested with them because they've come to the same conclusion. It's hard to pick the right real estate manager. Over time. So that, and I would go into this much more detail.
Yeah, no.
Both the asset class and the manager, but I'm just giving you how we've implemented it for other institutional clients.
I mean, again, it seems like it's good food for thought. I think, we probably need to get a better view in the round of where we are in this year's valuation and the actuaries, and get a sense of where we are and see where the markets go. And I've said in conversation with a client today is, big name in the financial industry that you would all recognize. And, their view is, they think inflation is easing, and their view is, they think things are going to come back, and they have eschewed any sort of, laying people off, even though their deal volume is down, etc. And, they think kind of, mid to late next year, they think it's going to be a different world. And, and so I think if we can get a sense of where the valuation is, get a better sense of where it is, because part of this is, were we to do this, and there's lots of ways to do this, and of course, as you point out, there's a lot more conversations to be had before we're even at a go, no go on something like this.
Right.
But even once we do that, I do think there's probably, a fairly nuanced conversation to be had about, well, what is the sensible time and the rhythm of our year to jump into this?
Right.
Not that we would time it for the market, but
Right.
I think we might time it for our own internal purposes. So we would need to kind of, I would have thought, have that kind of conversation and fold that into all the other discussions to be had on this. So,
Right.
but I honestly, Brian, I find it helpful that when we discuss about, what our performance is on these things, to constantly have this input on these types of investments, just to raise our awareness and comfort level and become more familiar with these things, so that, when we do kind of come around to, well, what do you think? Maybe this is a good time. We're not all kind of adrift on the jargon or how it's doing, and we'll have had some, there's a little bit of a history of talking about these things and learning about them from you. So I think that's helpful.
Yeah, I think it's always kind of great to come back to the objective and the time horizon. Certainly long time horizon, the objective, to be, fully funded or more, since it's an open plan. And how is the portfolio expected to do with respect to the discount rate? And those are the main topics to always come back to in thinking about the asset allocation. is how, where we would get grounded, and we never have, and, you know, I'm really, I'm really proud of the track record that the committee's done. I haven't been here for 20 years, but it's almost, in December will be 20 years with Vanguard. And if I could just show you, one other slide, on page 17. Shown this in the past, maybe once a year, I kind of do this. And I'll focus in on the 10-year number. And what this is looking at is, so Vanguard, the team that I work with, is considered an outsourced chief investment officer, that, where institutional investors, give discretion to the money manager. This is Alpha NASDAQ is a universe that's been put together of all number of OCIO providers, Goldman Sachs, BlackRock, Common Fund down here. And in order to give some transparency, well, how am I doing versus the broad market? And so this is the town of New Canaan's pension plan on page 17.
Okay.
And I'm benchmarking against, in yellow, the moderate asset allocation index. That's defined on the next page 18. It's saying, okay, a moderate asset allocation is where you're they call risk mitigating. Think fixed income is between 31 and 31 and 50%. And you could see in that chart on page 18 how many plans are in this universe of being measured against, right? So over a 10-year perspective, they don't tell you the names, but there's 89 other institutional plans. And over that 10-year time period, the town's pension plan, net of all fees, is 6.95 compared to this benchmark of 6.62. So, even with a very straightforward allocation, it's still very diversified and very low cost, which always matters.
Right.
It's performed, well versus peers.
Yeah.
Mhm.
No, I think
I wish there was a 20-year number, but there's not. I think the longest time frame they have is 10 years.
Yeah.
And so that's just a rough peer comparison in there for similar portfolios from a risk profile.
Well, look, the little clock on the wall is
Yeah.
Yeah.
saying
Yeah.
we need to do so.
Yeah.
So a couple things about it. So we have some new members, somehow I became the ranking, which is a little trouble. But I find your visits, obviously extremely helpful and kind of grounding, probably a good word for it. And so, we chatted a little bit about a schedule going forward in 23, but I just wonder if you might be able to make yourself available for some visits, perhaps a little bit off rhythm, just to kind of get us up to speed and
Absolutely.
early days, you know what I'm saying? And so, we have some official dates, but we could make these separate because it's not really for decision-making purposes. It might just be for familiarizing ourselves and answering some of the questions that we might have, et cetera, and kind of getting this committee up to a level of comfort with jargon and all the rest of it and the rhythm of what we're doing. And again, we could be all Zoom. It can be all, but I just think there's some benefit to that. And we're going to have the actuary come in, they'll give us evaluations, and so there might be some good data points there that we can say, okay, bearing all that in mind, let's go back and revisit some of these things and figure those things out. So if we could leave that on kind of a stay tuned basis, and then through Diane, we can kind of work that, that would be very, very helpful.
Absolutely, glad to do it all cycle. As a group, one-on-one. I'm sure there's been so many questions that are, being new to a committee about Vanguard or the portfolio, the markets. So I absolutely make myself available.
That's terrific. We appreciate that, Brian. And I think that what you need to do in there is just a version of what you just did there is perfect.
Yeah.
I would say, Dan, just to go kind of through this, if you would see if you could resurrect something that kind of put down on a list or an calendar what the annual rhythm of milestones are for us, our decision points, when those arise.
Sure.
We could all kind of benefit, and then we can look at that on the schedule and see if we need to modify it, and then we know we need to Father Brian.
Has there been an
Go
update of the funded status, of the actuary calculating that? I mean, I know it
Yeah.
always works with the lag as well.
Yeah,
Yeah.
You- you-
Well, I said February for results,
Right.
I push for January. But yes, and I used to keep a good log of meetings for the past.
Yeah.
10, 12 years, so I can easily get you it.
yeah,
for
that sounds-
maybe early next week.
that sounds great.
Okay.
Well, thanks so much.
To.
So,
adjourn,
I
yeah.
think, yes, so a motion to adjourn.
Okay.
And then we got a second over here, and so we're all adjourned. So we have this approved schedule, which we
Yep.
can share electronically with you,
I'll follow
Brian.
everything the next
We
day.
need to reach out just for, you know.
Yeah.
They're gonna be during regular business hours.
Whatever works best.
Fine,
Thank
60
you.
minutes at some point.
Yeah.
Thank you.
Sounds-
Thank you.
Thanks so much.